Good afternoon, everybody. My name is Clay Shark. You at Pioneer Bank, and we're doing a quick virtual webinar on how to complete the standard form for the loan forgiveness. This is actually the second one that we did. We did this same exact webinar yesterday, but we covered the easy form, and that one was recorded, and this one will also be recorded. So if you find this information useful, we will have this posted on our website soon after we get done. So it is there for you guys to reference. So again, today we're going to be covering the standard form. And the way that this is going to work is it's obviously a webinar, so it's a little bit of a one-directional thing here to begin with. But we do have a chat feature inside of Microsoft Teams that if you have any questions that could come up along the way, please use that chat area to throw what your questions are. And then we're going to have a question and answer time at the very end that will cover the questions that are there. And then any other ones that we don't have time to cover, we'll actually post on our website with what answers that we are able to track down for those. So with that, we will get rolling. All right, so first off, what are we going to be covering? So we're going to be just covering down to the basics of where even define the application. Next, we'll work through how to actually complete the application. And unfortunately, what you guys are going to find out is that the standard application is quite a bit more complicated than what the easy form is, but if we break it down into pieces, it goes as smooth as it can. Then we'll be covering what supporting information is needed to be provided when you submit your form for your application for forgiveness. We'll cover any timelines and deadlines that apply to you, give you a quick update on the PPP program overall, and then we'll round up with some question and answering. So first, where to find the application. So when you guys got a few of these emails from us to begin with, one of the attachments on that email was both the applications for both the easy form and the standard form, along with the corresponding instructions. But if you may have lost that email, or if you want to make sure that you have the most accurate and current version, you can get the application from the Treasury's website, and that's www.treasury.gov. And there's actually this little red banner here at the top that if you click that, that'll bring you into everything forms related for the PPP program. And specifically for the loan forgiveness applications, they're under the borrower section right there. So again, there's two different forms, and each form has its own instructions. So two forms. We got the easy form and we got the standard form. So the obvious question is going to be, which one do I need to complete? All right, so the easiest way to figure out what that should be is inside the easy form. There's some instructions that includes a checklist. And what that checklist does is it says, all right, if any of these certain criteria apply to you, you can use the easy form. If none of them do, then you need to use the standard form. We'll do a quick breeze through on what those criteria are. So the first criteria is the borrower self-employed individual, independent contractor, or a sole proprietor with no employees? So basically think of this as if you have employees, or if you do not have employees, you use the easy form. If you do have employees, then this one doesn't apply to you. You move on to criteria 2. All right, so the next criteria is, did the borrower not reduce wages for any employee by more than 25% during the cover period when you compare it to basically what it was pre-pandemic? And they define pre-pandemic as the time frame from January 1st to March 31st. And you did not reduce the number of employees or average paid hours starting from January 1st to the end of your cover period. So this one gets a little bit more confusing, but it'll round up a little bit here in just a second to kind of make it a little bit more clear. One thing to go and note though, is you can see the little asterisk by the word employee. In this case, this only includes employees that are less than $100,000 in cash compensation. So basically, if you have employees that are making more cash compensation than $100,000 per year, I guess what this means is you can go ahead and drop their wages and it doesn't affect you, at least from the PPP application. They might not be overly happy, but at least from the application standpoint, this only applies, this criteria is only referring to employees that are less than $100,000 per year. All right, and then if the first two didn't work, the third criteria, the first part is the exact same as the last one. So it is wages paid to employees that you did not drop it more than 25%, and that you were unable to operate during the cover period at the same level due to government rules. So think of this as the rule for like restaurants, breweries, things that the government required to be shut down that they just could not even have put hours on because they're forced to be closed. So if you can say yes to any three of those criteria, you can use the easy form. If no, then it's the standard form. Now, if you were to kind of look at the first criteria is pretty simple, but when you get into criteria 2 and 3, it gets to be pretty confusing. But I think if you go and take a little bit of a step back and look at kind of what the program is intended to cover and what the spirit of what this thing was trying to accomplish, it'll make a little bit more sense. And so obviously Paycheck Protection Program, the overall goal with this was to go and keep people on the payroll as we entered this weird phase of pandemic life. And so if you think of what payroll consists of, it consists of, the weight or the rate that you're paying somebody, how many hours that they worked, and then the number of employees that you have. Criteria 2 says is that you can make changes to the wage up to 25% decrease for people making less than $100,000 a year, but you cannot change anything from a paid hours or number of employees standpoint. On the flip side, criteria 3 keeps that same 25% wage reduction, but it's a little more flexible on the paid hours and employees as long as it was a government rule that you were following that caused that to happen. So again, if you're able to say yes to any of those 3 criteria, you can use the easy form. If not, you can use the standard form. And today we're going to be covering the standard form. But if going through this, now you realize that, hey, maybe the easy form does apply to me. We did record that webinar yesterday, and we'll have that on our website the same day that we post the standard form. So you can go ahead and refer to that one as well. All right, so here is the main portion of the standard application. And this page isn't too crazy. And what we'll end up doing is breaking this into sections. If we can break things into the pieces, it'll just be that much easier to work through. And so the application breaks into largely 7 different sections. And so from that standpoint, it doesn't seem too complicated. But then when you throw in all of the extra pages that come along with these things, plus just reading stuff from a government legal standpoint, it can be a bear to read through. And to kind of summarize all of that in an emoji, that's pretty much how everybody feels. But regardless of that, we can't change that. So we need to just kind of work through it as best as we can. And I hope that this webinar can help you guys navigate this as best as possible. Back to our application. Again, what we're going to do to make this as simple as possible, we're going to go and break each section or break the application into sections and work through each section one at a time. And again, those sections are contact information, PPP loan specifics, the covered expenses, which are the ones that count towards forgiveness. Then we have some adjustments, and think of that as the kind of government penalties that come along with changes in either wage or quantity of people. Then we'll get to the forgiveness calculation, certifications, and the demographic info. All right, so then what we'll do is just kind of start from the top and work our way down. The first part of the application is pretty self-explanatory. This is just the name and address and contact information for your business. So I'm not going to spend much time here because there's really not too much that can get confused. The next section gets into specifics about your PPP loan. And so this part has a little bit of extra information, and some of it may confuse you a little bit because you're like, I don't even know how would I know this information? And so there's a lot of information that we had on the bank side when we filled out the PPP loans with SBA on your guys' behalf. And so that extra information, I highlighted it here in green, and that information we included in some of the emails that we sent you that preceded this meeting, because this is information that you're going to need to be able to complete that application. And selfishly, it saved us from having to make a lot of individual phone calls to people. This way, we're able to get that information to you guys so you're ready for what the application is going to request of you. So just kind of working your way down the rest of it. When you get to the employees at time of loan application or at time of forgiveness, this is the quantity of employees. And now for this one, don't get too worried as far as big changes on beginning and ending. These two sections don't really factor into the actual forgiveness piece. There's a little bit more kind of full-time equivalence when we get down to kind of working through that part. So again, the employees area, this is more on a quantity rather than a full-time equivalent standpoint. And if by chance you don't have your application from when you initially applied, to know what you even had put for the original number of employees at application, you can go ahead and give your bank your call and they have a copy of your application if you'd like that. Next one that can kind of cause some confusion is in the covered period. So covered period, think of that as basically that time frame once you get the loan to be able to go and spend that money and qualify for forgiveness. So the standard way that the cover period works is it is the day that you receive your loan as the starting, and then it's an additional 8 weeks or 24 weeks after that. Okay, and so I say that that's the standard. You do have the option to choose an alternative payroll covered period, and that only applies for people that have payroll that gets paid on either a weekly or bi-weekly basis. So if you pay payroll less frequently, you unfortunately don't get the opportunity to choose the alternative. But if you do pay it on a weekly or bi-weekly, you can choose this alternative payroll period, which basically makes your starting date equal to the very first pay period that you would have otherwise run into. So if you normally pay your payroll on Fridays, but you got your loan amount, or you got your PPP loan on a Wednesday, this alternative payroll period allows you to move that start date to be that Friday rather than Wednesday. Next one that can cause a little bit of confusion is on the 8 weeks versus 24 weeks. And what that comes back from is there was an update to the kind of the CARES Act that was amended by the Paycheck Protection Flexibility Act. And what that did is it changed what was originally an 8-week cover period, and it changed it to 24 weeks. And the main goal there is that when we got at the beginning of this pandemic, we kind of thought that everything was going to kind of blow over pretty quickly and be back to largely normal by around June. And then as we got into this, we found out that that's definitely not going to be the case. And so then Congress acknowledged that as well, and they extended that time frame to 24 weeks. Now you're going to see a little bit of asterisk there. So with that change, the standard is now your cover period is 24 weeks. However, if you were one of the people that are one of the businesses that received a PPP loan before June 5th, so basically before that Flexibility Act started, you have the option to select an 8-week period if you'd like. So the standard is 24. If you got an earlier loan, you can choose to have it 8 weeks, or you can keep it 24. It's up to you guys. All right, now we get into the covered expenses portion. And think of this as basically where you're going to total up where you spent the money in towards those forgivable expenses. And so the large buckets of forgivable expenses that they have are payroll costs, business interest payments, business rent or lease payments, and utility payments. And so what we're going to do is going to break each of these down individually. We'll start off with the payroll costs. So first off, what's inside of payroll costs? Just from a high overview standpoint, this consists of cash compensation. So think of this as your wage or salary, cash paid directly to the employee. Then in addition to that, you can include other payroll costs like health insurance, retirement benefits, and state and local income taxes. But big thing there with those is this is only the employer costs. So if the employee paid a portion towards their premium, you don't get to count that. And same thing for retirement benefits. And then again, down to the state and local taxes, that is just the portion that was the employer's responsibility to pay. Now, when we look at this, you're gonna notice that in this payroll costs, it's gonna start referring you to a few of these extra schedules inside this application. And so If possible, it'd be nice if when you guys are watching this, if you could have a few pages of or have that actual loan application handy, because we're going to be kind of bouncing around a little bit, and I'm going to try to keep it as, work through as easy as possible as you can. However, the application does kind of jump us around from page to page, referring to different schedules and worksheets. So I'll do my best to kind of work our way through it in a logical way, but if you could have a copy of that application handy while we go through it, it'll make it that much easier when you get to the point of putting it together yourself. So in the case of the payroll costs, it's going to focus in on the what they call the Schedule A, line 10. Let's see if my computer will catch back up with me. All right, and so this now is on that PPP Schedule A. And so always love it when you have one small box that turns into a dozen larger boxes, but that's how bureaucracy works. So I think they get compensated by the number of pages they included on applications rather than how easy it is to fill out. But there again, our complaints ain't going to change anything, so we just got to kind of work through it. And again, kind of like the same thing as before, we're going to break things down into pieces. And so looking at this, it can seem like quite a bit, but it actually, if you break it down into pieces, it's not quite so bad. And the way that they can break down is this first section is the section that applies for any employees with a cash compensation of less than $100,000 per year. The second section is for any employees greater than $100,000 cash compensation per year. Third is those other payroll expense items, so healthcare, retirement benefits, and taxes. And then the last section is how do you deal with the owner compensation. And so we're going to start out with the employees less than 100,000. Oh, and by the way, for this stuff, we're going to, for now, skip line number 3. That's going to have something that's going to factor in when we get to the adjustments down at the end. If we were to cover it now, it'd be a little bit weird. So we're going to go and put a pin in that, and we're going to come back to that one here after a little bit. All right, so that's going to refer you to, I'm actually going to slide back a slide. You're going to see that the first section for the employees less than 100,000, that's going to refer you to now a worksheet titled Table 1, and you'll see that inside the application as well. Here is what that Table 1 looks like. And you'll see a little bit of a description. Basically what it says is included for, within this table, you're going to list out any employee that received compensation from you within your covered period. And again, this is for only employees that have a annual wage compensation of less than $100,000. And the way it's going to work is you're going to do one employee on every row. So you may, if you have a lot of employees, you may have to go and recreate this spreadsheet on a separate Excel sheet. But again, it'll be one row for every employee. And for now, we're going to skip that last column. And that actually jives with that line number 3 on the prior page that we skipped. So right now we're just going to skip out on that final column. And now let's kind of just work through what we need to put in each one of these. So the first 2 columns are pretty easy. All that is put the employee's name and then the employee identifier. And what that identifier means is the last 4 digits of the Social Security number. Next, we'll get into the cash compensation. So this is the salaries, wages, tips, or commissions that specific employee received during the covered period. So not just overall, but what they specifically received during the covered period. And then we're going to get into what they refer to as their average FTE and then the FTE reduction exception. So what this is now we need to kind of put a little bit of work into figuring out our average full-time equivalents because that's going to be something that's going to go and factor into a few other calculations down the road. So this one's going to have a little bit more into it. So this one we're going to hop a little bit more into. All right. So first off, what do they mean by an average full-time equivalent? So this, for an average full-time equivalent, it's basically I guess everybody knows what a definition of a full-time equivalent person is, which is just how many, if you work 40 hours a week, you qualify as a 1.0 employee. Half-time would be a 0.5. And so what this is saying is it wants you to figure out what was your full-time equivalence during this time. And it does give you the option of, rather than doing the full math on figuring out is this person at 0.6 or 0.3, it does give you the opportunity of doing a simplified version, which is if they work 40 hours, they're 1.0. If they work less than 40 hours, they're 0.5. So that may or may not benefit you, but you do have the option to choose that simplified method if you want. But for our example here, we're going to work through the details. Now, one thing to note is inside of this average full-time equivalence, they do have a few exceptions that you guys need to be aware of, because why this is important is that one of the adjusters that we're going to get to later is a penalty or a ding for changes in full-time employees as a result of kind of pandemic stuff. But it does go and say, all right, but if the space or the opening happened because of certain things, we're not going to hold that against you. And so what those exceptions are if you are unable to hire back a qualified employee, they're not going to hold it against you. If you had an employee that had been furloughed, but you tried to bring them back, but then they rejected you coming back for either safety reasons or just that maybe they enjoyed the additional paid or additional unemployment benefits that came along with everything, you are able to basically have that not be held against you. And then additionally, you do have other options for changes that happen due to firing somebody for cause, somebody just voluntarily leaving, and then also if an employee requests a drop in hours. So those are not pandemic related, so they don't hold those against you in this whole kind of how the penalty all works. All right, so now the question, how do we actually do it? And here is going to walk through a few examples that hopefully can make it a little bit easier on how to do this, especially when we get into a little bit more complicated scenarios. But what I found is, and what is kind of the recommended way, is that you track the paid hours during each covered period for each person. And so, like in this example, it's a very simple employee base. We just tracked during our covered period. So you're going to see weeks 1 through 8. If we had an 8-week, or if you had 24-week, it'd be 24 weeks. But what we are doing is tracking the paid hours for the employee over each of those weeks. And then in that column immediately after week 8, it averages those to figure out what's their average paid hours over the covered period. And then the far right-hand column is taking that average and dividing it by 40 and rounding it off to the nearest 10th. So in this case, this person had 40 hours per week. That resulted in an average of 40. 40 divided by 40 equals 1. So that's kind of just on a very simplistic standpoint how the how that full-time equivalence thing works. Again, average local wage weekly hours and divide the average by 40. And then you're just going to repeat that for all of your employees. Now, pretty easy, right? I mean, that doesn't factor in anything regarding hiring, firing, reduction in hours, or any actual scenario that every single business goes through during an 8 or 24-week period of time. So we'll go through kind of a few examples to see how we can kind of address kind of real life into all of this. All right, so the first example we're going to have is that we had an employee leave, but it was at their own, they voluntarily chose to leave, so that should immediately go and ring up a flag of, hey, this is an allowable exception, so this isn't going to get held against me. So we have somebody that leaves, but you were able to replace that position immediately. So they left on a Friday, and your replacement started on a Monday. I know it's not overly likely, but just for simplicity's sake, I just want to kind of go through what that example is. And so what is the main thing here is that we need to make sure that we're tracking each employee individually. And so if you look at the table above, we have our 2 employees. So employee 1 was the person who was there before. Employee 2 is the person who took over their position after they left. And so you see that employee 1 was rocking 40 hours a week for weeks 1 to 3, and then they drop off. And so for them, during the covered period, they averaged 15 hours over the course of the 8 weeks, or the equivalent of a 0.4 in the grand scheme of things. Now, on the flip side, employee number 2 was not employed by the business for the first 3 weeks because the other person was still there, but then took over for weeks 4 through 8. And during the covered period, even though they had 40 hours per week for the final 5 weeks, across all 8 weeks, it averaged 25, so they're a 0.6. So then what ends up happening is that between the two of them, they still come up to that same 1.0 full-time equivalent. Now, next one is going to be something to be a little bit more realistic on how the real world works. So in this case, same scenario, except it took us a few weeks to find a replacement. So again, that first employee was rocking out 40 hours a week for the first 3 weeks, but then it took us 3 weeks to find their replacements, and then the new employee started on week 7. And so you'll see what happened to their average paid hours. First one's still at 15, but the second one, now that they're only for 2 weeks rather than 5 weeks, that average dropped down to 10. So they're just a 0.3. So that means between the two of them, when it's rounded to the nearest 10th, gets to be 0.6. And there's a little bit of rounding in the background. That's why the numbers don't total up there. But if we don't make an adjustment for this allowable exception, we're going to get dinged because it's going to say, hey, you started out with somebody and you ended with less than somebody. You're going to get dinged for that. But since this one is an allowable exception because the employee left on their own voluntarily, that's where now this full-time equivalence exemption comes in, which is at the bottom of this table that we're filling out on that table 1. And so what ends up happening is you're going to see that we have that full-time equivalence row show up there. And then as employee 1 drops off at week 3, we have a gap period of a few weeks. You're going to see that during that time that the employee is gone, that we haven't found the replacement, that full-time equivalence is going to kick in and cover the hours that the other person was missing, so that at the end, and then as that other new person is hired, they fall off. And what ultimately results is that the end total full-time equivalence still stays at that 1.0 because that gap was an allowable gap. All right, third scenario. This one is, what if we had a reduction in hours and those exceptions do not apply? So in our case, we have that same person working for 40 hours, but then starting in week 4, we dropped them down to essentially half time. So then they work 20 hours a week for the final 5 weeks. Again, we're going to average out the total hours over the period of time. So for them, it's 27.5, which results in a 0.7 full-time equivalent. Now, in this case, reducing their hours is not an allowable thing as long as it was the business requiring it. Now, if the person requested it, then it's okay, and we can use our full-time equivalent exemption. But since it is the business saying that you're now going to 20 hours a week, we no longer get to use that exception. So you'll see that with this, our full-time equivalents would have dropped from 1 prior to the pandemic to 0.7 during our cover period. All right, so then going back to our table that we're filling out, once we finish that average full-time equivalence for all of the employees, that'll go into that 4th column there. Your full-time equivalence that we kind of covered there will go into that smaller star at the bottom, which will result in the overall average full-time equivalence in box 2. And again, at this point, we're going to be skipping that final column because it'll make a little more sense on that one when we get to that point. So this table 1 now is finished. So again, we're going to be now bouncing back to the schedule A. And you see that first section for employees less than 100,000, that part is now done. But again, we still haven't done line 3 because we're skipping that one intentionally. So now move on to the next one. Now we'll do that same thing for employees greater than 100,000. And what you're going to notice when we get to this point is it's nearly identical to table 1. Actually, the only thing that's gone is the section that we skipped on the less than $100,000 employees. That very final column just falls off because that wage reduction doesn't count against employees that were already making a higher income. So this table is the exact same as number 1. So you'll go through the same exact process. The only thing that is different is that with higher paid employees, there's a cap to how much of their income we can claim towards forgiveness. Now, this ultimately isn't a big deal because on the front side of getting our loans, we also cap their wage towards figuring out how much loan we qualified for. So by having a cap here, it isn't a negative against us because it wasn't a positive for us at the beginning. So that cap does vary depending on what amount of cover period that you have. So if you have an 8-week cover period, the cap that any individual employee's cash compensation can count is $15,385. And then if you're 24 weeks, be $46,154. And what those are is basically 100,000 divided by 52 times 8, 100,000 divided by 52 times 24. So we'll finish this table out for any of our employees that are the incomes higher than 100,000. Once you do that, now that second portion of our Schedule A is now complete as well. And we'll just keep working our way down the list. So the third section is now on those other payroll expenses. So inside of here, these are where we're going to be covering things like what amounts we spent on health insurance, state and local income taxes, and retirements. Now, big thing to remember that even though the total, compensation paid to a employee may exceed 100,000, the cap that we've always been referring to is only the wage portion. So if they had $90,000 in wages, 10,000 in health insurance, and 10,000 in retirement for a total of 110,000. They will not be capped because it's just that wage portion, that 90, that is capped at 100. And since that's lower, the cap doesn't result, and there's no cap when it comes to the health insurance and these other items. But one common theme you're going to see is that each of these, we do have to keep it on what the employer contribution is. So we can't include, what amounts the employee paid towards their health insurance or what the employee paid towards their retirement. This is only the employer contributions. And the only extra thing is on retirement. The owners can go and have retirement funded through the company as well to basically stop any funny business from happening. They do cap the owner's portion of retirement at 2.5 months worth of their 2019 contribution. And that 2.5 months, that is flat regardless of if it's a 8-week or a 24-week. All right, so then kind of continue to work down our list. That takes care of our other payroll. And now we get into the last one, which is the owner compensation. So owner compensation, big thing is just don't include the owner in either of the prior two tables. We want to have them specifically carved out. And the things to just kind of watch out for them is depending on what the cover period that you choose, there is a cap to how much owner compensation that we can include. And so how that all works is you will figure out what the cash compensation paid to the owner is during either of the two cover periods, but then that amount will get capped at the lesser of either $15,385 in the case of 8 weeks, and that's again that $100,000 annualized amount, or 8/52 of their 2019 compensation. So more or less, the owner can't go and give themselves a raise to maximize additional forgiveness if they hadn't been doing it previously. And again, same thing happens in the 24 weeks. But interestingly, one thing that they do include is instead of it going from 8/52 in the case of the 8 weeks to 24/52 in 24 weeks, they actually just plain cap it at 2.5 months. And again, The main reason there is owners are tend to be higher paid individuals inside the business, and what they didn't want the math to work out was a bunch of lesser paid employees get their jobs cut. However, forgiveness is maximized because they kept the high paid owner, and the owner still gets the full loan forgiven. So that's what this was trying to do, but it's just the world that we got to live in. So again, it'll be whatever that cash compensation was during whichever covered period, with a cap of the lesser of those dollar amounts or that portion of the 2019 income. So then once we take care of that, that'll actually take care of our whole Schedule A, and then we'll do the math that line 10 requires, and that number will then get carried forward back to our first page. And hey, we got one line done in this entire thing, and it only took us a lot of time to work through. So yay. Now, the rest of this does go a little bit faster. That was definitely the longest portion of the covered costs. But now we'll cover the rest of them. And these ones I'm going to breeze through a little bit faster because I know there's going to be a lot of questions when it comes to those adjustments. So we'll work these next through pretty quickly. All right, so the first one, business mortgage interest payments. So what this is we can include any interest paid on obligations that we had prior to February 15th towards that forgiveness. Now, big thing, got to pull apart how much was paid towards principal, how much is paid towards interest, because only the interest is allowed. We're not allowed to prepay interest, so you can't go and prepay the next 12 months of interest and just say that since you paid it, it counts. It does have to be kind of like what's incurred during the cover period. And one additional thing, when you see the word mortgage, it automatically makes people always think of real estate, but this is not restricted to just real estate. This also includes operating line interest as well as installment loan stuff on, say, equipment. So don't confuse the mortgage part with only real estate. It can be other business purposes, but it does have to be a business purpose loan originally. And big key there again, it does have to be a loan that existed prior to February 15th, because what they're saying is the whole goal of this was to help people maintain where they were through the pandemic. So it's not meant to, hey, I'm going to take out this new loan and then be able to cover it, because if you jumped into a new loan in the meantime, it's the rationale is that you were basing it off of what you planned your cash flows to be. So again, it has to be a loan that was in existence prior to February 15th. Next one is business rents and lease payments. Similar requirement as the mortgage, it does have to be in existence prior to February 15th. And again, not just real estate related, it can be leases and rent on equipment as well. Next one is the business utility payments. So similar to kind of the last two, it does have to be for stuff that's in service prior to February 15th. So no, you can't go and add a Hulu subscription in April and have a government reimburse you for it. I guess technically if you had it before, maybe, but it has to be something in service from February 15th, prior to February 15th. And the things you can include would be things like electricity, gas, water, telephone, which includes cell phone, transportation, and internet access. And so a lot of people question what the transportation consists of, and it gets to be a little bit gray, but kind of the general consensus is that it's the fuel, like those direct costs in operating the whatever transport vehicle used to run the business. All right, and then the last thing on these non-payroll costs is that all non-payroll costs, they do have to be paid during the covered period or incurred during the covered period and paid on the next regular billing date. So an example would be like an electricity bill, that maybe the electricity bill gets paid on the 15th, where your covered period maybe ended on the 5th. In that case, a portion of that electricity bill was for the benefit of the covered period. As long as you prorate that bill down to what would only be the portion covered in the covered period, and then paid that, and then you ultimately paid the electricity bill still on the 15th as normal scheduled payment, you can include those costs in your forgiveness amount. And so with that, that takes care of part number 3. Now we get into more of the again, more of the complicated portions. Because now what we're going to do is we're going to get into these adjustments. And unfortunately, think of these as kind of the penalty, I suppose, for reductions in either the rate that people are getting paid or the hours or quantity of people that you have on staff. And so similar to before, we're just going to take these one at a time. All right, so we get into that first one. Now, again, it's going to refer us to that PPP Schedule A. So we're going to roll on over to there. And so that is that one portion of the Schedule A that we had skipped previously. And so what this does, this feeds from that final column on that table 1. And what it's looking at is what was the impact of any wage rate reduction. And it's going to, throughout this, it talks about salary / hourly wage. I'm going to use the words rate to cover both of those. So if you ever hear me saying pay rate, that's what I mean is the salary and hourly wage. So for this line that we need to fill in, that's going to come in based off of a different area on that table 1. So we're going to go over to that table 1 now. Oh, actually, first we'll just kind of make it a little bit bigger so you guys can see. So here is where we type in what that impact is from that table. But let's go and hop over to that table to figure out what it is. So this is that table, and again, it's that last column that we're going to be figuring out what it actually is. Now, inside of the both the application and the instructions, they do walk you through how do you figure this stuff out. For me, it was a little bit difficult because it is written in paragraph format, so it's like kind of hard to track how these things move and go, and you got to do this thing, and then if it's that, then if it's this, you got to go over here, and if that, go over to this schedule, and you get totally confused like super fast. So what I put together was a little bit of a I call it a decision tree, which just basically maps out the yes/no questions that you need to figure out to point you in which direction you need to go. So I'm going to see if I can navigate that over to that decision tree. I'm going to stop sharing that, and I'm going to share that decision tree. All right, so this is the rate reduction decision tree. And again, what it's trying to be is essentially just a yes/no framework, just to kind of walk you through the questions that you need to be asking to know what you need to do. And again, I'm going to refer to this as pay rate, even though that's synonymous with salary / hourly wage. And this is going to be something that you're going to basically do this yes/no question for each individual employee that you have that makes less than $100,000. Now, a lot of this you can probably expedite into an Excel sheet, but at least if you walk through the process here, you'll know how to build that Excel sheet later. So what we're going to do is just going to work through what those questions are. So the first question is, did the employee's pay rate decrease by more than 25% during the covered period when you compare it against their average pay rate basically pre-pandemic, and they call that January 1st to March 31st. So if their rate did not increase or did not decrease by more than 25%, you'll answer no, and you just enter a 0 into that person's salary wage reduction column. And again, this is what their rate is, not necessarily the amount that they got paid, but just the rate that contributed towards it. So if they're hourly, were they $15 an hour before and $15 an hour later? Those two are the same, you enter 0. This does not factor in things like the hours that they worked, which may have ultimately resulted in either higher or lower pay being given to them. This is purely talking from the rate standpoint. So again, in any case, if you know that you have not dropped anybody's rate across the company, then you can just answer no for all those and put 0 into that column, and you're done with this section. But assuming that somebody that you could answer yes at some point, we're going to keep walking through that tree. So let's pretend that we answered yes to that. Now it's going to give us a couple other tests to work through. The first one is, all right, now that we know that, Next question, is the employee's average pay rate between this certain period of time equal to or higher than what their pay was as of pre-pandemic that they define as 2/15/20? If it's a yes, they prompt you to complete the rate reduction calculation for them, which will be over on this to the left there. Or no, it's going to prompt you to another question. And so let's just assume that we said no. Now it's going to say, all right, now as of either the earlier of December 31st, 20 or the date of loan forgiveness application, did the employee's rate, or was the employee's rate equal to or higher than what it was on February 15th? So basically what this is saying is at the time of application, even though you may have reduced their wage during the cover period, if you raised it back up again by the time you apply this forgiveness application, they're not going to hold it against you. So if you can say, yes, my employee's pay rate is equal to or higher to what it was pre-pandemic, then you'll enter a 0 into that column, even if during the cover period it actually was lower. Again, they're just saying as long as you got them back up, we're square. But if you say no, now it prompts you to go and complete that rate reduction calculation for that employee. And so now we'll kind of go over to that rate reduction area. And so for that one, it starts off with a initial calculation that you'll do for that employee. And that calculation is taking what their average pay rate was from January through the end of March. And then you're going to multiply that by 0.75. Because if you remember, all of this stuff talked about as it was the reduction more than 25%. What this 0.75 does is it says, we're not going to ding you for the amount that we're allowed to reduce by. And then you're going to take that adjusted number and you're going to subtract out what the average rate that they had during the cover period was. So what was their average hourly rate for your 8-week cover period? You're going to figure out what that difference is. And then if they are hourly, there's a little bit of math that you're going to do. You're going to figure out what is the, you're going to take that result, which is going to be like $1 per hour. And then you're going to multiply that by the average number of hours that they worked pre-pandemic, and then multiply that weekly number now by the number of weeks in your cover period. And then that resulting number is going to be something you're going to put into that reduction column for that employee. Now, similar but slightly different calculations for salary. You're going to take that same result from above, which is now going to be shown more on an annual basis. And then you're going to take that ultimately divide it by 52 and times by 8, or times by 24, depending on what your cover period is. So it's going to take that annualized change, prorate it down to what was 8 weeks worth or 24 weeks worth, depending on what your cover period is. And then that number is what you're going to put in for that specific customer. And then there again, you're going to just repeat this process for every single employee that you have that makes less than $100,000. And now if I can, I'll navigate back to the presentation. All right, and then when you get that all done, that result for each individual employee is going to go into that final column that we had previously left blank. All right, so once we do that, then we'll carry forward the total into here. Or if there aren't any, we're going to enter a 0. And that'll carry forward into our adjustments. And now we have that line 5 finished. Now line 6 is pretty simple. That's just doing some math, adding some stuff from above and subtracting it out from the line 5 that we just figured out. And so then the next one is going to be, all right, now how do we do this full-time equivalence reduction quotient, which sounds really intimidating, and it a little bit kind of is, but it's not as bad. But if you think again of what consists of payroll, it's the rate you pay people times the hours that they work times the quantity of employees. We've addressed that rate already. Now we got to adjust the other 2 variables. All right, so when we get into the application, this is going to give us all right, now here's how you do this full-time equivalency area. And here again, is something that brings it into a bunch of paragraphs. But the key thing is going to be this first portion here. What that does, it basically gives you a whole bunch of exemptions where things won't get held against you. And so then here again, it's a lot harder to work through when you're looking at things in a paragraph statement. So I have broken those again into a decision tree just to kind of help people navigate through it. All right, so let's go and navigate to that one. All right, and here will be that decision tree. All right, so for this one, you're going to look at this more so on a overall basis, not on an individual employee basis. And so what we're going to do is start out with the question, did you reduce employees or average paid hours of employees between January 1st and the end of the covered period? If you can say no to that, then you qualify for criteria 1 in that this area is not going to get held against you. Now, one key thing to go and point out is in that question, it talked about, obviously reducing employees. That was pretty self-explanatory. But the second one talks about the average paid hours, which can be different than what the worked hours are. Some businesses that received the PPP loans did reduce the hours that their people worked from, say, 5 days a week down to 4 days a week because their need for them had dropped, but they still paid them for the full 5. So in that case, even though the work hours dropped, the paid hours stayed the same. So they would be able to answer no to this case and then basically skip this portion of the application. But assuming, yes, I did go and drop that during the cover period, then it's going to give me a couple other options for getting excluded from this. The first one is, were you able to operate between February 15th and the end of your cover period, or were you unable to operate between February 15th and the end of your cover period due to government mandate? So here again, if the government told you to close, they're not going to hold it against you and ding you from a forgiveness standpoint. So if you can say, yes, I was unable to operate, then you can go and you qualify for that exemption and you don't have to continue any further. Now moving down the list, assuming that that is not the case, now we get a final opportunity is your average full-time equivalence between February and April less than your full-time equivalence at the pay period on February 15th? If you can say that no, it is not, then you need to complete the full-time equivalence. But if you can say yes, it is, it's going to prompt you again for an additional question, which is why, again, with these things, it makes more sense to kind of look at them in a decision tree, because looking through this in a paragraph gets really difficult. So if you say yes, next one is your full-time equivalent as of the earlier of December 31st or the date of forgiveness application equal to or higher than what it was on that February 15th pay period? So here again, it's saying as long as by the time either 12/31 rolls around or with the date that you apply for forgiveness, did you bring those people back? If you said yes, you don't get dinged. If you say no, now you got to go and do that calculation. And then from there, assuming we answered to the point where it always sent us to complete the full-time equivalent reduction calculation, we'll work into what does that mean. And so what that is first we got to determine our average full-time equivalence during our chosen reference period, because the full-time equivalence today is just a snapshot. We need to know if it's up or down or different. We need to have some sort of reference period to compare it against. And what they do is they say, all right, depending on if you're a seasonal company or a non-seasonal company, you got a couple different reference periods to choose. And the way that it's written is that you can just choose whichever reference period you would like. So obviously it's in your best interest to choose the one that's most advantageous. But for non-seasonal employers, you have a couple different time periods to choose from. You can choose the February to June of 19 time period, or the January to February time period. And kind of the reason why there's two different ones is to factor in either companies that were either new or just starting up in 19 that were growing in 20, now it makes more sense for them to use the 20 information versus an existing business that's pretty stable using the 2019 information. Now, seasoned employers have the exact same opportunity, but then they also have one additional option, which is they can just choose any 12 consecutive week period between May 1st and September 15th. So they have just an additional option to figure out what's that base reference point that we're going to be compared against. Next, we'll determine our average full-time equivalents for the covered period, and that's going to be one of those totals, or it's going to be the combined totals from those two tables that we filled out on the individual employee basis. And then from there, we're just going to then compare, all right, what was our covered period relative to our reference period? And if it is less than 1, we're going to carry that through, and that's going to be a kind of a ding towards forgiveness. So if you had 80% of the employees that you started against, the forgiveness part, a portion of your forgiveness will get dinged by that 20% change. However, if you maintained or increased, it'll keep that as 100%, so you won't receive that same ding. And here again, the maximum, even if you come out at a 1.1, it maxes out at a 1. So that's kind of how the full-time equivalence one works out. I'll bring it back to our presentation now. All right, so again, this was the kind of the Word version of what we just went through. And ultimately, it's going to bring us down to that line 13. So that number that we may have just calculated, all of those situations brings us to row 13 on what the result is. So if it were the criteria where you could skip it, it told you to enter a 1.0 there. If you had to go through the calculation and came out with a 0.8, this is where you put that 0.8. And then from there, that line would then flow forward into that line 7 inside the full-time equivalent reduction quotient. So now this portion, section 4, is now finished as well. All right, number 5, we get into the forgiveness calculation. So this one, a little bit easier because it's just doing some math. The first line is taking is factoring that full-time equivalent quotient into what our forgivable expenses were. So again, it's going to take your forgivable expenses and kind of do a couple of adjustments if there was changes in either wages or number of hours worked, or hours paid, I should say. Line 9 is where you're going to enter your PPP loan amount. And number 10 is going to be your payroll cost 60% requirement. And this one gets a little bit of confusion to it on what that's trying to do. So we're going to do a little bit of an example on that one. So what the payroll cost is it's a sliding scale. So part of the rules that the CARES Act had was, actually, interestingly, it did not have it actually. In the original CARES Act, it had nothing as far as what minimum portion of the loan had to be spent on payroll. But then SBA and Treasury arbitrarily added 75-25 to that requirement. Got a lot of people up in arms about it because there's some businesses that are more, say, facilities dependent and less labor dependent. So it would make it really difficult for them to qualify for forgiveness. Along with that Paycheck Flexibility Act, one of the other changes that they did was they changed that 75-25 to what was called the 60-40 rule. And this is a sliding scale, and what it does is it always tries to make it so that whatever payroll was, it maintains at least a 60% minimum portion that came from payroll. So go through an example quick. So we have an example of a customer had a $100,000 PPP loan, and so for them to get that, they would have had to have average monthly payroll of $40,000 at their application. So 40 times 2.5 gets you to the 100,000. And then let's say that during the cover period, they only spent $48,000 on payroll. So then how this 60% requirement factors in is going to take that 48,000 and it's going to divide it by 0.6 to say, hey, for us to go and maintain our 60% proportion, the maximum loan that can be forgiven is now 80,000 because 48 divided by 80 is 60%. So again, if you spend less, it doesn't, originally there's a fear that it was going to be a cliff, that if you didn't meet the 60%, it just was a zero forgiveness. This new 60% is a sliding scale. So as less is spent on payroll, that maximum forgiveness goes down proportionally. Now on the flip side, scenario 2, let's say that they spent $80,000 of payroll during that time, which is basically keeping the staff that they had on for the whole thing. Well, again, we'll take that 80,000 and divide it by 0.6, which is going to give us 133,000. And then ultimately, the way the forgiveness works is it takes the lesser of the three. So basically, they check the box of maintaining that 60% proportion, so they don't have to worry about that one causing less forgiveness for them. And that takes care of the kind of the numbers portion of everything. Next, we'll get into the certifications, which obviously is important to read, and that is something that needs to be initialed by somebody on behalf of the company. But for those ones, it's pretty self-explanatory. It's basically making sure that you fit the requirements to use this application, as well as certain just following the rules that had been previously laid out. And then part 7 is a demographics area, and this is actually optional. And it's actually kind of funny because the reason why it's in there now and it wasn't to begin with was that the SBA got their hands slapped, because the original CARES Act actually required demographic information get collected, but SBA just didn't include that on the initial application. They got their hands slapped. Now it shows up here, but the key thing for you guys is that it is optional. So if you complete it, it is required for any owner greater than 20%. So think of it as any of the people that you put on the application to begin with, because we had to list out who the owners were greater than 20%. Any of those people, you got to do the demographics for if you so choose. If you don't, it's not going to be held against you. And selfishly, from the bank standpoint, I guess if there's less for us to review or ultimately input to give to SBA, the better for us. But ultimately, that's your guys' decision, and it is an optional field. All right, then we get into kind of the supporting documentation. And for this one, I'm just going to kind of highlight where you can find this. They actually give a pretty thorough answer on the instructions. It'd be the last 2 pages of the instructions. It goes through what is required to be submitted with the application, and then what other things are not required to be submitted, but you got to at least have documentation for. So pretty thorough. So I'm going to point you and highlight that for you guys to know what is required from that standpoint. And then lastly is, all right, now that we know what to do, when do we got to do it? This also got changed with the Paycheck Protection Flexibility Act. Now the loan forgiveness application needs to be filed within 10 months of the end of the cover period. And so if you kind of work through how the timeline works, let's say you got your loan on May 1st and chose the 24-week, that's going to now push you to somewhere in the November timeframe for when your cover period ends. And then you got 10 months past that. So now you're looking at September of 2021 by the time you need to submit your loan forgiveness application. Now, things to be aware of with that is that, obviously the beginning loans had just a 2-year repayment. So any longer period of time taken into that application does chew into that residual period of time to repay the loan. Now, we do have the option to change that to a 5-year, but it is something that we have to both the bank and the customer agree to. So I just want to make sure everybody's aware that it's not, we don't want to go through all this and find out that now I got 6 months to pay back any type of residual loan. So once the loan forgiveness app is submitted, the bank has 60 days to review it and then submit it to SBA. And once it's submitted to SBA, SBA now has 90 days to review it and make the decision and send the payoff for whatever forgiveness amounts that there are. And one thing is that when that forgiveness does come, SBA does pay the interest. They have not clarified what that means for loans that are partially forgiven. So what I would assume that means, and I would have everybody plan for, is if you do have believe that you're going to have some residual loan, plan for SBA to at least pay for their portion of the interest. So if they had 50% of the loan ultimately forgiven, they'll cover half of the accrued interest, but then the other half that wasn't forgiven would be the responsible of the business. And then just another kind of FYI, this has obviously been a program where we're building the airplane around us as we fly it. And at this point, SBA actually hasn't even told banks how to submit the forgiveness applications to them for their 90-day review. So just kind of ask you guys to, be flexible with us as we kind of work through this process. And if things change, obviously we'll let you know, and we'll do our best to make it as smooth of a process for you guys as possible. But again, this is something that's kind of being created on the fly. All right, so then the big question that everybody always has is, all right, now with the change to 24 weeks, if I got my loan in April, I got to wait till October to be able to apply, but I've already spent my money. Or maybe I did after, say, not after 8 weeks, but I did after 10 weeks. So now what? Can I apply for my forgiveness before the end of my cover period? And the answer is yes. However, any of those reductions in wages, any of those, basically those reductions, you do have to go and carry those forward through the full period of your covered period. So an example would be if you had dropped wages and it caused a, I don't know, say $2,000 a month in less wages, you got to carry that for the full 6 months in the case of the 24 weeks, not just maybe the first 10 months that you did during at the point where you filed for the forgiveness. So a little bit of extra stuff there, but it's not too onerous. But one of the nice things that comes along with that changing from 8 to 24 weeks is that even though that ding gets bigger, you have the opportunity to spend, 6 months worth of, what would have been 2.5 months worth of wages over the course of 6 months. So likely people won't get, really hurt by that, because that initial wage amount will be so much more because they have 6 months worth of wages that can count towards it. All right, then before we get to question and answers, we do just have a quick kind of updates on the PPP program itself. So it was extended. Previously, the program ended June 30th. On the 11th hour, they came to the agreement that, hey, there's $131 billion left out there. Let's give people a little bit extra time to use it if they can. So that end date has been bumped out to August 8th. Now, obviously, there is still the rule that it's only one PPP loan per business. So probably wondering why I'm bringing it up to a bunch of people that already have them. And the main reason is that we want to be able to get the word out for people that may have missed the boat. So to date, we've been able to do around 700 of these PPP loans and 700 individual businesses. We'd like to be able to help that many more if we can. It's just we've run out of people in our Rolodex, so we need your guys' help too. So anything we can do to get this money into the hands of the businesses that need it is what our goal is. All right, that gets us to the kind of questions time. I do apologize for going a little bit longer than I had anticipated. So again, this stuff is recorded, so feel free to follow off whenever you like. This is something that we are recording, so we'll able to you'll be able to catch up on whatever you missed when we post it to our website. And again, when that does happen, when we get onto the website, we'll be sure to let everybody know where they can find it. But at this point, we're going to go over into the kind of the question and answer area. I hope I can go and answer the questions that you guys have, but if I don't, which is probably highly likely, because this gets pretty complicated and stuff that does need research. If there's things that we can't figure out, what we're going to do is we're going to take those, do a little bit of extra research, find out the answers, and then along with those videos, we're going to have a frequently asked questions area that will include that answer right inside of there. So have some people that have been monitoring the chat. Dwayne, do you have any questions that have come up that you want to get covered?
Clay, we've got a few questions, and first I want to thank everyone for being on the call with us today. I'm going to go ahead and end up asking those couple questions and then turn it back over to Clay to wrap up the call. But again, thanks to everyone for being with us. And again, a huge thank you to Clay for stepping through this. Again, it'll be, as he said, it's recorded, so therefore you can, as you're filling out the application, kind of go back and watch each section as you complete that application. So one of our questions was, is our banker that worked with us going to help us through this process? And by all means, the bankers are available to help you with that. So should you have questions, we will find the answers and work through that process with you. And quite honestly, Clay, you did a great job, because I've only got one other question for you, and it is, if an employee was terminated for cause, but a replacement was not hired prior to the close of the 8-week period, can you still use the FTE reduction exception to calculate your average FTE on Table 1 of Schedule A worksheet?
Yes. And so the only additional thing that you'll need to do is probably provide some sort of documentation that can at least prove out that you have still put forth a good faith interest or a good faith effort in filling that vacancy. But yeah, as far as if as long as the person is fired for cause, that is an allowable exemption. So that the gap in FTEs caused by that won't get held against you. Now, if it goes for a long period of time, that's where you're going to want to go and be able to document that, yep, we had the posting out on, within a week of their leaving, and it's still out there active, as of today. So having some of that documentation will help true that up. But yep, you will not you can use that FTE exception number to fill in that hole.
And that's all we had, Clay, for questions. So I'll let you wrap it up.
Sounds good. So thank you guys for the time. I apologize again for going a little bit over, but it's a complicated thing, and we wanted to do our best to help you guys navigate it. If you do have questions that come up in the meantime that you didn't, going to go through the application later and be like, dang, I wish I had asked that question. On the screen, you do have an email address that we do monitor for those questions. And so that's ppploans@bankwithpioneer.com. And then we'll also be using any of those questions to populate that frequently asked questions area on the website too. So obviously we'll take out any unique things to the person asking it, but we'll use the generalities of it to help others that may come up with the same question. So that is all that we have for today. Thank you guys for attending, and wish you guys the best of luck. And again, yes, we're here to help you guys navigate this stuff as best we can. And thank you for the opportunity to letting us help you out on the beginning. So with that, everybody enjoy the rest of your day.